Hello, everybody. Just making sure everybody can see my video now and that you guys can hear me talking. Let's see here. Perfect. Okay, 4 o'clock on the, well, we're a minute behind schedule, already running late. So first of all, I just want to thank everybody for joining me today. We really appreciate this. Is a pretty darn good turnout. We have 26 people on here right now. It's one of the better turnouts for one of our webinars. And I think that's probably due to the fact that there is so much fear and anxiety and concern going on in the markets these days. So great turnout. Unfortunately, the circumstances aren't great. But I'm glad that you logged in to hear what we have to say today. I'm really excited to share some information with you and, looking forward to the information that we have to share. Most of you, and I checked the participants here a couple of times, know who I am. But for those of you that don't know who I am, let me introduce myself. My name is Chris Ingram, and I wear a couple of different hats here at Prosperitas Financial. I am the CEO and founder of the company, as well as a financial advisor for the last 25 years. Many on the call are clients of mine and have been clients of mine for many, many years. And then I am also the head of the investment committee here at Prosperitas Financial. And a lot of the portfolios that we manage here at Prosperitas are portfolios that I created many, many moons ago. So most of these portfolios, the majority of them actually, were created during the dot-com bubble back in 2000. And they've gone through several different iterations and adjustments and updates over time. But for the most part, they are what they are from a very long time ago. So they've been intact for quite some time now. I'm going to share my slides now, and so you guys can stop looking at my funny face here. Let's see. Oh, and I can still see myself. Perfect. Excellent. So today we're going to talk about a bunch of different things, but predominantly we're talking about the markets and the worries and concerns that some of you might have regarding what's going on in the markets currently. And first, I want to start with talking to you a little bit about our webinar series. Keep in mind, this is a series. So this is the first of the quarterly webinars for 2022. We are going to have one every single quarter, and I'm looking forward to the webinars in the future where we can talk about how much money we're making and how excited we are about all the good things and positive things that are happening in the markets. But unfortunately, that is not this kind of webinar. We're talking about fear, we're talking about anxiety, we're talking about stress, we're talking about negative returns in the market. And so this is going to be a little bit more of a down webinar series. Actually, I'll take that back. The markets are down, but we're going to turn a positive out of it and tell you all the good things to look forward to. So what we're going to talk about today are a couple different things. First, we're going to talk about what is causing the market turmoil. We're going to talk a little bit about the history of market declines, and in my opinion, why they're really not all that bad. And to some degree, they provide a lot of opportunity. And I actually look forward to them occasionally because they provide such great opportunity to make money. And then we're going to talk a little bit about what we see going forward from some of our past experiences. And then we will go over our portfolios a little bit and talk about some adjustments we've made this year to weather the storm and things that we see us making adjustments throughout the course of the year to kind of prepare for what we see going forward. And then we'll close out. We have a guest speaker with us, Dr. David Jelinek. Jelinek, he runs the Rational Funds Special Income Fund, Special Situations Income Fund. It's a mouthful. And it is a fund that we added to our portfolios this year because of its unique style. And it brings something different to the table in what is going to be a challenging year for the markets and for fixed income portfolios. And so I'm excited to have him here to kind of tell you what his fund is all about, because it is a bit complicated and he'll do a better job of explaining it to you. But I think it's a great addition to the portfolios and looking forward to hearing him talk. So let's talk about it. So it's been a very difficult start to the market. And this chart here is a chart that I printed out about a week ago. So these numbers have changed a little bit, but as of the time that I printed this out, you'll see that the purple line was the NASDAQ, down about 25 to 26%. The blue line here is the S&P 500, down just shy of 16%. The yellow line is the international markets, just shy of 17%. And what I think is most interesting this year is the pink and the orange line. The pink line is the aggregate bond index, and the orange line is the high yield bond market. And why I think it's so interesting is that you have the aggregate bond market that's down almost 11% year to date, when the S&P is down just shy of 16, which just shows what a difficult market it's been for fixed income. And fixed income notoriously is the more conservative asset class that rounds out a diversified portfolio and provides protection and safety when the markets get volatile. But as you can see, there has been no place to hide to start this year. The fixed income portfolios have done, had a rough start to the year because of the interest rate hikes we've seen from the Fed. And so I'll point to that upper left-hand corner, and it says worst since 1939. And one of the things I'll show is, this is a headline that I saw, I don't know, a few weeks back, and it said, this is the worst start to the market since 1939. And the only reason I added it to this slide was to point out some of the fear that the media and the talking heads on television try to shove down your throats. And they take little snippets of data, and I've seen it many, many times throughout my 25 years, and they manipulate that data to create some kind of a very scary headline. And I believe in some ways the data is real and there actually is some truth to that statement. But when you see something that says worst since 1939, you think, all hell's breaking loose. And at the end of the day, the S&P 500 is down just shy of 16%, which is really not all that bad in the grand scheme of things. We've seen much, much worse. So it's definitely a fear-driven headline that they try to get you as scared as possible. But it really is not all that terrible up to this point. So what is causing all this fear and concern? Well, I would say the main cause for all the concern is inflation and the effect that inflation may have on the economy and a potential recession. And so another fear-driven headline that I saw recently is it said that inflation hasn't been this high going back all the way to 1982. And that is true. The last reading we got in April was 8.3. The reading before that was 8.5% inflation. And we haven't seen those numbers since 1982. The difference was that back in 1982, we were dealing with a much different situation. Inflation rates were falling at that time. In the late 70s, inflation was somewhere in the ballpark of 14 to 15%. And in 1979, our Fed chair became a gentleman named Paul Volcker. Paul Volcker, when he became the Fed chair, vowed to bring inflation back down to single digits, and he would do everything in his power to do so. And that's exactly what he did. He drove the Fed funds rate all the way up to 20%, which is a far cry from the 1% that we're at today. And he brought unemployment to 11%. And he brought our economy to one of the worst recessions we had seen since the Depression. But he was successful in his quest. He drove inflation from 14.8% all the way down to 3.8% by the end of 1982. It was just a very, very painful way of getting there. Today is a much different situation. And while, again, the headlines will try to compare the two, I don't think you can really compare the two. It was a very different market environment. Back then, you would hear people say that they were taking out mortgages on their home and they were paying 12% on their mortgages. Interest rates were very, very high. Inflation had been burning very, very hot for quite some time. And it was just a very different market environment. Now, We're going to have challenges and some similarities, but for the most part, this is a different market, and I don't think it's fair to compare it to what we were experiencing back in 1982. So let's talk about inflation. What caused inflation to spike? And so it's a combination of things. And the first thing was Fed policy. So if you were paying attention, about a year ago, the Fed came out and they said that inflation had been too low for too long. We were running under a 2% average for quite some time, and they wanted inflation to average 2%, and they were willing to overshoot that in order to get us there. So they actually said that they were willing to let inflation burn a bit, maybe go to 4%, 5%, something over that 2% marker to get us back to that 2% average. So the Fed had already had a mindset that they were going to let inflation run a little bit. And so their policies were geared towards that, keeping interest rates low, keeping money available, and keeping the economy burning. And so what I think the Fed missed in all of this was the effect that COVID was going to have on the economy. And so COVID created a very difficult supply chain that was hurt very heavily by COVID itself. And so there were a couple of different ways that COVID did that. First and foremost, people weren't at work. And so while people were sent home and they weren't at work, there was no manufacturing going on, the machines had been turned off, and we weren't creating new supply. Throw on top of that, you had a lot of dock workers, truckers, so on and so forth, that weren't working. And so you might have heard that a lot of shipment containers were being held up in the ports and not moving from one place to another. And so this was a result of COVID, where people were not going to work, were not moving those supplies across the globe. And so you weren't finding supply on the shelves in your store. And you probably remember this during COVID when you went to buy toilet paper and you realized that there wasn't a lot of it. Toilet paper was a little bit of a weird situation, but you probably also noticed that there were other supplies that were not sitting on the shelves, and it was difficult to get at that time. And part of that was due to this global supply chain breakdown that happened during COVID. That's on the supply side, and I'll talk a little bit about how this works with inflation on the supply and demand. But on the demand side, at the same time as the supply chain was faltering due to COVID, you had a lot of demand that was being put into the system through a couple of different channels. Number one was government money printing. So the government did a lot of things during that time to stimulate the economy, stimulus checks, PPP loans, EIDL, so on and so forth, where they were putting money into your bank accounts. And when people get money put into their bank accounts, the first thing we want to do is go out and spend it, which created demand for supplies. People wanted to go out and buy things. On top of that, the Fed kept interest rates very low, which created a housing boom. And that housing boom not only really did two different things. One, when you have an $850,000 home and it goes to $1.2 million, you feel rich. You feel like you have extra money in your pocket. You want to go out and spend it. And then throw on top of that it gave people the opportunity to do out a cash out refi from their home, pull some of that equity out of their home, put it into their bank account, and spend that money. And so what a lot of people did during COVID is that they were sitting around staring at the walls of their house, and they saw a lot of the flaws in their home. And so they took a lot of that money and they put it back into their home in remodeling their home. So there became this demand for lumber and appliances and tile and steel and copper and so on and so forth. So additional demand for supplies. On top of that, unemployment started to fall. We had unemployment in 2021 that was 3.8%. A lot of people will say that that number is a little bit skewed because a lot of people left the workforce during that time period, which is probably true. But at the same time, unemployment was relatively low and it was hard to find good talent. So on top of unemployment being relatively low, there was a 6.2% increase in wage. because we were trying to attract talent. And so employers were willing to pay a little extra money to get good talent at their companies. And so those who were working had a little extra money in their pocket to spend. And so how this works is when you think about supply and demand, is that whenever, let's use an example. So if you have 5 widgets that are sitting on the shelf and you have 15 people with money in their pocket that want to buy those 5 widgets, well, there's a lot of demand for those 5 widgets. So the company that makes those widgets can raise prices on those widgets because there's such a high demand for them. And so that's what happened, is there was very little supply. So the shelves were bare and there was pretty high demand for goods. And so you started to see inflation started to spike up because companies were able to charge a little bit more for the supplies that they had sitting on the shelves. A lot of people think that Russia and Ukraine is the cause of all of this. And Russia and Ukraine was actually more of fuel that they threw on the fire. So we already had inflation that was spiking and starting to burn. And then when Russia and Ukraine started, Ukraine being a very large producer of wheat, Russia oil, you started to see those prices spike as well because we weren't able to get those. And so you saw energy prices and food prices start to spike even more. And so inflation started to spike even more than it was previously. So Russia and Ukraine really just added to the problem. So how do we fix it? Where do we go from here? So Economics 101. So I'm going to look to this chart over here on the left-hand side. And so if you look at this red line right here, this is S1. That's where supply was during COVID. And so, or prior to COVID, actually. So S1 over here. And demand was this blue line down here. And so you get price over here, quantity over here. And so you had a certain amount of quantity and price, and our prices were down at this level, P1. What happened during COVID is that supply chain issue started. So our supply dropped to this red line and our demand spiked due to all of the extra money that we had in our pockets. And so when supply fell and demand went up, you'll see the new intersection up here drove us up to P2, which is when prices went up. So that's what we experienced previously and what got us to this place. So how does the Fed use this to bring prices back down? Because ultimately that's what the Fed is trying to do, is bring inflation back down. So the Fed really has 2 things to work with. They have supply and demand. So the first thing they can do is get supply, which is at S2, to improve and come back down to S1. Or they can get demand, which is out here at D2, to drop down to D1. And if you get S1, the new supply, to come back down here, and D1 back down here, then we'll get prices to come back down. So here's the problem with that, is that the Fed doesn't really control supply very much. So part of the problem with supply, like I mentioned, is that really it's about getting people back to work, getting the machines turned back on, getting manufacturing to take place and goods back on the shelves. And so that's something that's going to take time. And with everything we've been through, that's just something we're going to kind of have to wait for it to work itself out. The other thing that's an issue with supply is moving goods around the world. And so if you look at this chart here, these are some of the world's busiest ports. Here's the top 20. And what you'll notice in this slide is that this port right here, the biggest port in the United States, is the Los Angeles port, and it's number 18 on the list. So what that shows us is that the US doesn't control a lot of shipment of goods around the world. What it does show us is all of these red ones here are China. And China is really the one that's in control of the majority of the supply moving its way around the world. And so what we really need is China to kind of get back to work, get away from its COVID restrictions and start moving supplies and goods around the globe so that they can find their way to the shelves and we can start having more supply to sell. But that doesn't help the Fed very much because they don't control that aspect. What the Fed can control is demand, and that's what the Fed is working with right now. And so there's a couple of different ways that the Fed can work with or reduce demand. And the first way is to raise interest rates, which is what they're doing right now. And so what does raising interest rates do? Well, it makes it less likely that you're going to purchase something on credit. So let's use a car, for example. If you were planning to buy a car and you went to the dealership and that car has a 1.9% interest rate, you may say, great, I want to buy the car, and you go ahead and take it off the lot. However, if all of a sudden you go to buy a car and the interest rate is 5.9%, well, the monthly payment may be too much for you. It may be out of your price range, and you may just decide that it's not worth it to buy that car. And so it becomes less attractive for you to buy that car. And so some demand has been sucked out of that market because you no longer want to buy that product. That can go for cars. That can go for houses, mortgage interest rates rising. That can go for RVs and boats, appliances, furniture, anything that you're going to buy on credit that you would no longer want to buy because the interest rate is now too high. That also can spill over into businesses. Businesses are less likely to borrow money, expand, buy equipment, because borrowing money is now more expensive because interest rates has gone up. So the whole idea of the Fed raising interest rates is to suck some of the demand out of the system and get consumers to stop spending their money. However, I think what the Fed is really trying to do, or would love to do the most, is create a ton of fear. Because fear also gets us to stop spending, right? So if you look at what's happening in the stock market, if your 401k is dropping, if your real estate values are dropping, if you feel like the world is uncertain and you're not clear of where we're going, you are less likely to frivolously spend your money on things that you might not need. And so by creating a lot of fear, they get consumers to put their wallet back in their pocket. And so this really is the better outcome for the Fed, if you think about it, because let's look at the US. The US right now has $3 trillion in national debt. Okay, so the last thing the Fed really wants, or the US government really wants for that matter, is for interest rates to rise. Because as interest rates rise, the cost of servicing that debt for the US government becomes more and more expensive. So at the end of the day, I don't believe they really want interest rates to go up that far. And one way to prevent that from happening is to create as much fear as possible and get consumers to stop spending before they have to go on with all these additional rate hikes. That additional fear also spills over into the corporate world. If you feel less certain about the future or where the economy is going or where the markets are going, you're less likely to hire, you're less likely to give pay raises, you may even lay people off. And so you take some demand and money out of the system, which then lowers the overall demand for goods and services, which helps bring pricing down and helps fight inflation. However, the problem with all of this, and what I think is the real concern out there, is that all of this has a potential to cause a recession. And I think that's what everybody's ultimate fear is. So if you think about if inflation stays high, that could cause a recession, because if inflation's high, it makes it harder for people to buy the things that they need. That may not be as much of an impact on the ultra wealthy or the upper middle class. But when you talk about the lower middle class and the lower class, as it becomes more expensive to buy food from the store or fill up their tank with gas, they become in a pinch. And so they either stop spending or try to pull away, or worse, they start putting all that stuff on credit cards and they start piling up debt in order to maintain their lifestyle. And so that can spill over into a way of creating a more difficult market environment and potentially a recession. And also the Fed raising interest rates and creating all this fear, well, that also is designed to slow down the economy. And if the Fed pushes too hard, they could push us into a recession. And so it's a really difficult balancing act between keeping inflation at a place where it doesn't push us into a recession and dealing with fighting inflation through interest rate hikes and slowing down the economy without pushing us into a recession. And there's a lot of people that are worried that the Fed may not be able to do that, and that ultimately we will find ourselves in a recession. And so that's where a lot of this fear is coming from right now, is how that is all going to play out. But I will say this, when it comes to recessions, is that it's not a guarantee that we're going into recession. I can't tell you how many times in my 25 years in this career that I've heard people say that we were going into a recession, and we never actually went into the recession that everybody was afraid of. So first thing to keep in mind is a recession is not inevitable. We could avoid it. It's possible. And so all of those that think it's inevitable that we're heading into a recession, that is not the case. We could still avoid a recession and make our way through this. That being said, I will point out that the initial reading for GDP, the first quarter of 2022 was a negative 1.4%. And a recession, by definition, is 2 quarters in a row of negative GDP. So we already had one negative quarter at the beginning of 2022. If this second quarter comes up negative, well, guess what, folks? We are actually already in a recession. And we could find that out at the end of this second quarter. And that is the funny thing about recessions, is that you typically don't find out you're in a recession until after you're already in the recession, because you need the quarterly GDP data in order to tell you that you had 2 negative quarters in a row to find out that you're actually in a recession. So you typically don't know until after the fact. But it could be that we're already there. The last thing that I'll mention about recessions is that not all recessions are 2008. So a lot of people think of recessions and they immediately flash back to 2008. 2008 was a very difficult time period with a lot of problems. The Great Recession, close to a depression to some degree. And a lot of people think every recession kind of looks like that. That is not the case. Even if we go into a recession, it could be, and there have been, mild recessions that are not fun. They're not the greatest thing in the world, but they're also not the end of the world and not as painful as what people remember from 2008. So even if a recession is coming, it's possible that it's mild and not all that terrible. We saw that with the recession in 2020. We also had a recession in 1990, that they were what they were. They weren't great, but they certainly weren't what we experienced in 2008. I will also point out about recessions, and I mentioned this a few moments ago, is that you don't know you're in a recession until after they've passed. So I'm going to use 2008 as an example. So in 2008, we had negative GDP the first quarter of 2008, and then we had positive GDP in the second quarter of 2008, followed by negative GDP in the third quarter and negative GDP in the fourth quarter. So it really wasn't until January of 2009 that we officially found out, hey, we are officially in a recession. The problem with that is that the stock market had already fallen 45% by the time we got there, and we were just now getting the news. On the flip side, the first and second quarter of 2009 were negative, and it wasn't until the third quarter of 2009 that we had positive GDP, meaning that it wasn't until about October of 2009 that they officially called the end to the recession. And by that time, the market had already started rallying in March of 2009 and had rallied all the way through, almost a 45% rally to the upside by the time we found out we were out of the recession. So if everybody was waiting around for the all clear signal, they waited around far too long before they got back into the market, because the market is a leading indicator, not a lagging indicator, and it had already moved in anticipation of what was to come. So that is what we're challenged with. That is the difficulties we face: inflation, possible recession, all of the fear that surrounds that. So what does that mean? Well, whenever we're worried about a recession or we're scared about the future, markets tend to fall. Whether we go into a recession or not, markets tend to pull back. And we've seen that through history. It's happened quite a few times. And so I'm going to go through a couple of different examples here of previous market declines. In 2000, you had the dot-com bubble burst. You had September 11th. Followed by a recession during that time period, which we saw the S&P 500 drop 45% during that time period. And it actually is on record as the longest bear market in history. I think it lasted somewhere around, I don't even know, 27 months. And the S&P dropped a full 45% during that time period. In 2008, you saw the Great Recession that we've talked about several times now. Stock market actually started falling in October of 2007 and went all the way down to March of 2009, a full 55% for the S&P 500. But there are others. Those two are very famous for what they were. There was 2010. How many remember what happened in 2010? Probably not a lot. Because it was not as extreme as 2008. But in 2010, that was Brexit. So Brexit, UK was leaving the EU, and there was a lot of fear surrounding that. And in just over a 2-month period, the S&P dropped a full 15% in fear of the outcome of UK leaving the EU, which is, if you put that into context, that's about what the S&P 500 is down year to date so far today. In 2011, another one that I'm sure a lot of you don't remember, but in 2011, we had the European sovereign debt crisis. You had several countries in Europe that were feared were going to default on their debt, and there was a fear of contagion for all the different countries that owned that debt. And it was a time period where we saw a downgrade of the US credit rating, which was the first time that had happened in a very, very long time. And in a 5-month period, we had a pretty severe sell-off of the S&P 500, where the market dropped a full 20%. In 2015, does everybody remember that one? Probably not. That was when GDP out of China started dropping, and people started to fear about a slowdown in China and how that was going to translate to the rest of the global economy. On top of that, we had several flash crashes in the market, and Greece was defaulting on their debt. And in a 9-month period, you saw the S&P drop a full 13%. Then there was 2018. In 2018, and this was the last time the Fed raised interest rates. They raised twice at the beginning of the year. And in September, they came out and said, we're going to raise once in September. We're going to raise again towards the tail end of the year. We're going to raise 3 times in 2019 and 2 times in 2020. And what did the market do? The market panicked, said, we are going to go into a recession if they do that. And the market dropped 19% from September through to Christmas Eve. And Christmas Eve that year was the worst Christmas Eve ever for the stock market. It was also the worst Christmas Eve for me being a financial advisor, because I was literally on the phone with clients right up until dinner that night. And was a very difficult time period for the market because of, again, fear of rising interest rates and a fear of a recession. What I will note is that the day after Christmas, the Fed came out and said, we are going to take a wait and see approach. And the day after Christmas, the Dow Jones was down at one point, I believe, 1,000 points, and finished the day up 1,600 points. It was the biggest one-day turnaround for the Dow Jones, and the markets rallied from that point forward and never looked back. They recovered all of the losses by about March of 2019. Then you have the most recent one, which I'm sure all of you remember, which was COVID. COVID started, nobody knew where that was going, feared the recession, which we actually went into a recession during that time period, and where the pandemic was going to go. And you saw the S&P drop 28% from top to bottom during that time period. So you know what all of these have in common? 100% of them have in common, because I hear a lot, this time it's different, and they're all different. They're all unique things that drove them and started them and created them. and whatnot, but they all have one thing in common, and that's that every single one of them recovered. Some faster than others, but all of them recovered, and some of them in very dramatic fashion. Like I said, the 2018 drop recovered very quickly by March of 2019. You saw the COVID recovery happen very, very quickly. Even 2008, if you go back to 2009, the market recovered almost 50% in 2009 from the bottom when we dropped during the 2008 crisis. So every single one of them came back. So let's talk about investing. So this is one of my favorite quotes ever when it comes to investing, and it's from Peter Lynch, who is the fund manager for the Fidelity Magellan Fund. And he said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And so I'm going to give a couple of different examples of what I think Peter Lynch meant by this. And the first one is there's a lot of people who are constantly moving in and out of the markets. And so I'll give you an example. If you look at just what we were talking about in 2015, the big drops and spikes that we saw in 2015, there were people that thought something bad was going to happen. And so they were jumping in and out of the market, trying to anticipate what was coming. That was a very difficult time period. I had clients at the end of 2018 on Christmas Eve who wanted to get out of the market, and you saw the dramatic rally the other direction in 2019, where they're trying to get out, time the market, move back and forth. And that can be very devastating to a portfolio. And I think that's partially what Peter Lynch means, is that because people are constantly trying to anticipate or prepare for corrections, they end up putting themselves in worse positions than if they would just ride them out. They actually say that the average mutual fund investor captures about half of the returns of the mutual funds themselves because of the poor timing they have when they jump in and out of those very mutual funds. And so I think a lot of that comes from that back and forth in and out of the market that Peter Lynch was talking about. But I'm going to give you a couple of more examples that are actually real examples. These are real clients of mine, but I'm switching up the dollar amounts and the investments to make it a little bit easier to illustrate. But this is 2008. And so I had two clients who came to me in October of 2007 and wanted to invest with me, which, looking back, is the absolute worst case scenario. It was the top of the market right before one of the biggest pullbacks we had ever seen. And so the first investor, again, the real investor put it into a diversified portfolio and didn't do exactly what the market did. But for example, the first investor gave me $1 million, and we're going to say that he put it 100% in the S&P 500. And so that investor in October of 2007 put $1 million in the S&P 500. By the time the market bottomed out in March of 2009, that $1 million would have been $450,000. That's a pretty horrible start to an investing career. However, this is what the market has done since then. And if you look in this bottom left-hand corner, that's 2008, that little blip down there. And this is everything that's happened since then. And if that investor stayed invested that entire time, that $1 million that they originally invested back in 2007 would now be worth roughly $2.6 million. They would have made $1.6 million on their investment, even though they went through a horrible roller coaster ride to start that investment career. However, if I go back, let's talk about another client. Another client had $1 million. Said, I'm only going to give you 200,000 of it. I'm going to keep the other 800,000 in my bank because I'm scared and I'm worried and I want to see how it goes. Well, obviously we invested the $200,000 into the S&P 500. By the bottom, that $200,000 was now worth about $90,000. And she was devastated, did not want to be invested anymore. However, we left the money invested. But she felt very happy she kept the other $800,000 sitting on the sidelines. And ever since then, that $800,000 has sat in her bank because she now doesn't trust the markets. She thinks they're a sham. She hated the experience of losing all that money and doesn't want to ever be invested with all of her money with all of that risk. And so her $1 million today is worth 1 million, just over $1.3 million. So by having her fear and keeping that additional $800,000 sitting on the sidelines and never getting into the market, her $1 million has only gone up $300,000 through the last 14 years, where the first client who went on that vicious roller coaster ride to start the investment career is now sitting on a portfolio worth $2.6 million, even though it dropped all the way to $450,000 right off the bat. And so I think, again, this is what Peter Lynch is talking about, is those that are fearful of possible corrections or anticipating the corrections. And so they keep so much money sitting on the sidelines, they miss out on all the opportunity that it presents, and they miss out on the long-term growth that can come from being invested in the stock market. Another example of what I think Peter Lynch was talking about, and this is another real-life example of a client. Just get me out, and then we'll get back in when it's safe again. And so this happened during COVID. And this is a client that wanted to get out during COVID. And if you look in the upper left-hand corner, this is an actual email or a snippet of an email that I sent to this client telling him what I believed was going to happen. He said, S&P 500 was at 3,500. It started to drop. It got all the way down to 3,000. And he said, things look really scary. I think it's time that we went to cash. I think it's going to get a lot worse. And so he wanted out of the market. So the market was dropped to 3,000. By the time he read my email and said, no, definitely get me out of the market, and market was dropping rather quickly, he got out of the market where this red arrow is. And so I said in the email, if you go back to my email, I said, what's going to happen next is the S&P 500 is going to go to 2,700. You're going to say, this looks like it could be really bad. I think the market is going down 50%. The news is awful. And the market continued to fall. And I said, hey, the market's going to go down to 2,500, which it went a little bit past that. And I said, you're going to say, see, I was right. I'm smarter than Chris. This is getting terrible, and it could get much worse. I don't want to be invested. I'm so glad that I moved to cash. Oops. And then this happened. So I called him up where this green arrow is, and I said, you should probably get back into the market. And if you look back at my email, I said, when the S&P rebounds to 2,700, you're going to say the news says that this is not the bottom. Do not trust the bounce, and that I should sit on the sidelines a little bit longer. And the actual conversation with the client was this. He said, I have a doctor who is a friend, and he says that a second wave is coming, and that I think the market is going to go back down. I'm going to continue to sit on the sidelines and wait it out. Then the market did this. And in my email, I told him, I said, once the market hits 3,000, you're going to say, shoot, we missed it, but it has gone up way too far, too fast. I'll put some money to work on the next pullback. And that's almost exactly what he said here. He said, this is not justified. I think there's a pullback coming. I'll get in on the next pullback. And while there was a little pullback, it wasn't enough to get him back into the market. Market pulled back and rallied all the way up to here. And then this is where he decided it was time to get back into the market. And if you look at my email that I sent to him way back when he was talking about getting out of the market, I said, then the S&P is going to get to 3,500. And you're going to say, I can't believe we missed it. And he didn't say, I can't believe we missed it. He said a lot of other things that were a lot of four-letter words being thrown around because he was very upset with the way that it had turned out. But he should have never cashed out down here. And now he's trying to get back into a market that coincidentally was almost exactly where it was when it started to fall. So a lot of investors, when they say, get me out and I'll get back in, this is a common mistake that I see happen. And that's why I knew when I sent him this email that this is what the experience would look like, because I've seen it time and time again. Getting out is one thing, but trying to get your way back in and knowing when to get back in is very, very difficult. And often the market rallies very, very quickly and makes it very difficult to decide what to do. Another example is a different client of mine. He called me up actually right at the bottom. It was March 23rd. He called me up on the phone and he said, Chris, get me out of the market, put me all in cash. I said, no, you're going to go to the bank and give me more money. He said, "Are you crazy? I'm not giving you more money. I'm actually going to take my money out." And I said, "No, you're going to go to the bank and give me more money." I talked him into it, and he actually gave me $200,000 that we added to his portfolio. And this is a segment from that email I sent to that previous client. And I said, "This is what you should do, is at 3,000, you should hold tight. At 2,700, you should invest a little. At 2,500, you should hold your nose and invest a little bit more. And then when it rebounds to 3,000, you'll say we made some money, and at 3,500, we'll be in a much better place." So this other client gave me $200,000. We didn't invest it all at once because we didn't know if the market had officially bottomed at that point, but we put 25% of that money to work every 2 weeks for the next 8 weeks. And today, that $200,000 that he invested in the stock market has made $90,000 for him, because he did what Warren Buffett says, which is this quote right here, that Warren Buffett always says, "Be fearful when others are greedy, and greedy when others are fearful." And people were very, very fearful at that time. And he was greedy. He went in and bought the market instead of running away from the market. And it paid off for him quite a bit. But this is why I was so sure when I sent that email to the client that this is how it was going to turn out. Because this is typically what happens. Markets rally quickly. And what this chart shows here is the 10 best days for the market over the last 20 years. So what this shows, and we use this a lot, that if you go back to 2002 through 2022, and you take that 20-year return for the S&P 500, if you would have invested $100,000 in the S&P 500 20 years ago, you'd now have $616,000. But if you miss just the 10 best days, and a lot of these days are in 2008, 2020 during COVID, 2009, 2020, if you miss just the 10 best days in the market, that same $100,000 only grows to be $282,000 over the past 20 years instead of $616,000. And why this is so challenging and why this is troubling to most people is because often the worst days in the market are the days after, the best days in the market are often following the worst days in the market. And that holds true for some of the best years in the market, often come right after some of the worst years in the market. If you look at 2003 after the 2003 after the 2000 to 2002 crash, 2003, the NASDAQ was up almost 50%. The S&P 500 was up 27%. And if you look at 2009, the markets rallied something like 45, 50%. Coming out of what we experienced in 2008. So when you get out during those bad markets, it typically rebounds really, really quickly. Either it's the next year or the next day. And if you're not there to participate in it, it eats up into your returns over time, which is why it's so difficult to time the markets and try and get in and out, and why it's such a devastating thing to do to your portfolios. So what does this mean for your portfolios? So first of all, don't panic, okay? Stay calm. So what we talk about a lot, or I tend to say a lot, is that staying calm is a superpower. So being calm in situations makes you clear-headed and makes it easier to think. And if you look at, any situation, unfortunately in this world these days, we deal with a lot of shootings and craziness. If you're calm in that situation, you have a more likely chance of protecting yourself, protecting your family, and getting out of that situation safely. I think the same is true for investing in the stock market. It's very important that you remain calm and you think logically and don't think emotionally. Another thing to keep in mind for your portfolios is that even in the worst case scenario, so going back to the client that I told you about that became a client in October of 2007, even if you ride that market all the way down and you ride the market forward for the long term, that client's $1 million turned into $2.6 million, which is a pretty darn good rate of return over a 14-year period. And even though he basically had the absolute worst timing of entering the market ever. So even in the worst case scenario, things can work themselves out and are not all that bad. So stay the course. Next one is focus on your plan or have a plan. If you're a client of Prosperitas, most likely you have a financial plan. If you don't, understand that that is something we very much do and are very much an advocate of. We believe that you should have a well-written, documented plan, understand where you're trying to go and make sure you understand what your goals are, and make sure that your portfolios and your investments are geared around whatever those goals may be and what your time horizon looks like. So make sure to readdress during these times what your plan is, what your goals are, and make sure that your allocations and your portfolios coincide with that. If you're pulling income from portfolios, make sure that your portfolios are in line with a portfolio that is trying to generate income and is built for those types of distributions. If you're one of my clients, they are. And if not, we can review that and make sure that they are. And lastly, add to your portfolios. Like the client that gave me $200,000 at the bottom of COVID, Warren Buffett always says that he likes to buy his socks the same way he likes to buy his stocks. And that is when socks gets confusing. When socks go on sale or at a discount, he loads up on his socks, and he does the exact same thing with stocks. When they go on sale, he buys more and loads up on them. And you can see that in some of the actions he's taken recently, as he has been very vocal about the fact that he has taken an 11% stake in HP. He's added quite a bit to Citigroup. He's bought into Chevron. He's bought Activision recently, and he's continuing to add to his Apple position as that stock becomes more attractively priced and valuations become more attractive. So let's talk about our portfolios in general and give you a little bit of information when it comes to that. So if you're invested in our models have something called tactical positions. These are the portion of the portfolio that we move in and out of the market depending on the ebb and flow and what we feel is going on. And depending on the portfolio, our aggressive portfolios have 30% allocation to our tactical positions. You'll see our growth and income portfolio has a 20% position in tactical. We entered the year 2022 with about half of our tactical positions sitting out of the market on the sidelines. Not so much because we were overly concerned about what the market was going to throw at us, but we felt that there was a possibility of a pullback. There were some risks that we were worried about, and we felt like we wanted some dry powder sitting on the sidelines to be able to invest when prices went down and got cheaper. And so we had some of that sitting over on the sidelines, a lot of that which we pulled out of tech because we had been heavily invested in tech prior to 2022. And we are just now starting to take those tactical positions and put those back into the market. Just last Thursday, when the S&P was hitting about 3,800, we took about 25% of our tactical position that we had sitting on the sidelines, and we actually allocated that back into the market, trying to take advantage of pricing. We don't know if that's the bottom. I think there's a possibility the market could go down. It could go down another 10 to 15%. But we felt like there was a good place to enter, and we've kept some additional dry powder sitting on the sidelines. So if the market falls a little bit further, we can buy more. But we felt like that was a good spot to start, and we feel pretty good about that position already. Growth versus value. So we, prior to 2022, actually 2021, we were heavily leaning towards growth, which is most of your technology stocks and your high growth positions. In 2021 and rotating into 2022, we have lightened our load on growth, and we have gone into more value positions, so dividend paying stocks and better valuations. This has provided some kind of support to the portfolios. As you will see, this purple line right here is the NASDAQ. Since we made the change, the NASDAQ is down 13%. And since we added to our most recent addition to our dividend portfolio, our value hedge, that thing is basically flat during that same time period, and it is paying us dividends on top of that. So moving out of growth and into value has been a way for us to bring the risk down a little bit and bring a little bit of stability to the portfolios and bring some income to the portfolios. We are getting to a place, though, where as tech continues to drop and pricing becomes more attractive, we are starting to look at maybe shifting that back the other direction at some point. We're not there yet. but there will come a time where we start to say, well, value has run its course, and we will start to move back out of value and start to pick up some of those higher growth tech names in the portfolio. And you just look at it from a simple example. Right now, if you look at Google as a stock, Google has a price to earnings ratio of 20 now with the big sell-off. And you're seeing companies like Procter & Gamble with a PE ratio of 27, Altria with a PE ratio of 41, and Coca-Cola with a PE ratio of 28. And so you're starting to see tech stocks that are now looking like they might even be a little bit more attractive to some of the value names that are out there. And that will start to lean us the other direction. And that will be the point where we start to take some money out of value and buy back into some of those growthier names in the portfolio. But as of right now, that value twist has played out well for us and has taken away some of the risk that we've seen in some of the higher growth technology names. The other change we made to the portfolio throughout the course of the year is we increased our exposure to alternatives. What are alternatives? Well, alternatives are things like hard assets and commodities. So you think of precious metals, real estate, lumber, energy, wheat, corn, futures contracts, currencies contracts, things that are not your traditional stock and bond allocation. And so we owned this fund going into 2022, but we increased our position in this fund throughout the course of the year. And we have taken from things like the S&P 500 and some of our bond portfolios in order to increase that weighting. And you can see this blue line here is the alternatives fund that we have in our portfolio, which as of the most recent addition is up 8.7%. While the S&P 500 during that same time period is down 6.3%. We actually think this will continue. We're going to continue to lean more into alternatives throughout the course of the year with everything going on in Russia and Ukraine and just some of the other supply constraints that we see. We think that this might continue to run for a little while. So we are going to continue to be a little bit of a heavier lean on alternatives for probably the remainder of 2022. One of the biggest challenges we face this year is something I mentioned at the beginning of this webinar, which was what's going on in the bond market. You see that pink line again is the aggregate bond index, which is down 11%. The orange line or yellow line is the S&P 500 down 16%. That blue line is actually TIPS, which are Treasury inflation protected securities. You would think if you listen to some of the news in the markets that inflation protected securities would protect you in an inflationary environment. But we owned those in 2020 and 2021, but we actually got rid of those going into 2022 for fear that they would start to drop as we anticipate inflation had peaked and starts to come down. And as you can see, TIPS are down over 8%. I believe that number is. As of the time that we made that change, or I'm sorry, year to date. And what we did move into was two things that I think have helped out a lot, is we moved to shorter term bonds. Shorter term bonds are less susceptible to interest rate hikes and don't move as much when interest rates are volatile like this. And they also hold a little bit more stability for the portfolio. So we moved our bond positions to the short end of the yield curve. But more importantly, what we did is we added quite a bit to this purple line, which is what is called floating rate securities. Now, floating rate securities, just so you understand what they are, they're kind of like a variable rate bond. And really what they are is they're very, very short-term bonds, typically something like 7-day paper. So, which means they mature every 7 days. So because they're so short term, they really aren't as susceptible to what's going on in interest rates. With interest rate hikes, they don't care as much. And then every 7 days as they reissue, the interest that we are getting paid on those bonds starts to increase right along with rising interest rates. And so you'll see the purple line, we came out of things that were like this pink line, which is down 11%, went into the purple line, which is still down a little bit, but far better, down 2.9%. But we also have rising interest rates or income coming out of this portfolio as the year has progressed because of what has gone on in the interest rate market and with the Fed moves of interest rates going higher. The last thing that we made a change to, and I will finally an hour in. So again, I apologize. I knew this was going to be a long one today, but I will bring on our guest speaker because this is another fund that we added to the portfolio. Because we knew fixed income was going to be a challenge this year, and we knew that there weren't going to be a lot of places to hide in the fixed income markets, we started looking for alternatives and ways to add value to your portfolios that were off the beaten path or things that were not typical bond portfolios. And we came across the Rational Funds Special Situations Income Fund, which one of the managers of that fund is Dr. David Jelinek. And he is on with us. And it is a very unique style, very non-traditional fixed income mutual fund. And so I am going to bow out here for a little bit, stop sharing my screen. I'll give the screen to him and he can tell you a little bit about what his fund does and why we added it to the portfolio. And then I will come up at the end for a little bit of a conclusion, and then I will let you guys go for the evening. So take it away, Dr. Jelinek.
Okay, can you hear me?
I can hear you. You're good.
Okay, great. Okay, good. Okay, well, my name is David Jelinek. The fund I work with is called the Rational Special Situations Income Fund. I think of this fund as a bond, an alternative to traditional bond funds. It is a fixed income fund. We do trade bonds. We don't have the same risk exposures that people are used to in bond funds. When people look at bond funds, they worry about interest rate risk and they worry about credit risk. There is a small amount of that exposure in our fund. It's nowhere near what you would get in a traditional bond fund. Now, how do we accomplish this? Our primary focus is non-agency residential mortgage-backed securities. I will show a picture that explains exactly what this is. I'm going to share my screen for just a minute here. Okay. So this is an artist's conception of a mortgage-backed security. The idea here is that you have a bunch of people who have mortgages. These are their houses over here. My business partner thought it would be funny if one of the guys was upside down on his mortgage. And they are paying principal and interest every month. The idea is that you can sell a whole bunch of bonds to people who are looking for fixed income. And the way that the bondholders get paid back is that every month when the homeowners pay their mortgage, that money is collected and paid out to bondholders. So you pay up front for this bond. Every month you receive principal and interest, which is just taken from the principal and interest that the mortgage holders are paying. Now, this is, I think by itself, that's a reasonably simple idea. Pre-2008, I think a lot of you remember that banks tried to get really fancy about this. And they said, okay, we can make it more complicated than that. We could have different levels of seniority for bonds. So we could set this up so that some of these bonds are considered senior. If you buy one of those bonds, you get a slightly lower coupon, but you're the first one to get paid. So every month, principal interest comes in from the borrowers, and the first thing they do is they pay the senior bondholders. If there's money left over, they move on to what I have here called the mezzanine bondholders. There's no standard terminology here once you get past senior. If there's money left over, you move down to the third level. These are called tranches. So you have different tranches of bonds. They represent different levels of seniority. And the bondholders get paid in order. And if money runs out, it's the guy at the bottom who gets shortchanged. If money is really short, maybe the bottom 2 or 3 tranches don't get paid. But the senior bonds are the safest. You know, banks put together a lot of these mortgage-backed securities pre-2008, and it didn't really work out as planned. And in 2009, the founder of our firm, his name is Eric Meyer, came to me and said, David, there's a tremendous opportunity here. This entire asset class is stigmatized. No one wanted to tell their boss that they were holding mortgage-backed securities, and that stigma lives on today. It's not as bad as in 2009, but still people get scared when they hear about mortgage-backed securities. And he said, there's a tremendous opportunity. He said, look, there are all these different tranches here. These bottom tranches are very risky. I don't know what they're worth. It could be close to zero. The senior-most tranches are a tremendous bargain. And I want to start a fund that owns senior bonds primarily. So that's what he did. In 2009, he started that fund, and it's been tremendously successful. The reason we weren't scared of the risk, even though there was a lot of turbulence in this market in 2008, well, there were a couple of reasons we weren't scared. For one thing, we own senior bonds. Those are going to be the safest of all the different tranches. The next thing is that when you own one of these bonds, what are you afraid of? You're afraid that these homeowners aren't going to pay their mortgages and they're going to default. And then the bondholders don't get paid enough. Now, this happened in 2008. A lot of people defaulted on their mortgages, or they were forced to sell, and bondholders lost money. Those houses disappeared. Those mortgages don't exist anymore. So when you bought one of these bonds, your only exposure was to the homeowners who were still paying their mortgages and hadn't been kicked out of their houses yet. So, this was a really lousy situation. It was lousy to live through. If you came along after the financial crisis and you bought one of these bonds, you were counting on a bunch of people paying their mortgages, but only those people that were still afloat. So you were getting this exposure to a very reliable set of borrowers, not the ones who, through bad luck or whatever, didn't survive the financial crisis. So we really like that aspect, that as lousy as the situation was, our exposure was to these very reliable borrowers. Now, if you fast forward to 2022, okay, your exposure is still to the borrowers who survived the financial crisis, but also these borrowers have been paying their mortgage since 2008. They've built up a lot of equity in their homes, and housing prices have gone up. If you look at the average borrower in one of these pools, they have north of 60% equity in their homes. That's a good predictor of how creditworthy a borrower is. How much equity do they have? People with 65% equity or 60% equity typically keep paying their mortgage. They don't get fed up and pour concrete down the toilet and abandon the house. There's no incentive for them to do that. So we really like that set of borrowers. So we have exposure to a good set of borrowers. They have a lot of equity in their home. They survived the financial crisis. And then on top of that, we're typically buying senior bonds. The next thing you could say is, well, what about interest rate risk? This is obviously a big story this year. Aren't you afraid of interest rates rising? The answer is generally not. The majority of what we hold is floating rate. So when interest rates go up, the interest that we earn goes up with it, and it has a minimal impact on our net asset value. I have a quick chart showing this. All of our models say that we have low interest rate risk. We actually went out and measured it. And this is a nice scatter plot we have. On the x-axis, we have the change in 10-year interest rates. On the y-axis, we have our performance that month. And over the lifetime of the fund, there was a slightly positive correlation. We made a little bit of money when interest rates went up. The correlation was close to zero. In the last year or two, it's roughly reversed. We lose a little bit of money when interest rates go up, but it's nowhere near the exposure that someone would have in, let's say, the aggregate bond index. If you have exposure to the aggregate bond index, you have roughly a 7x exposure to interest rates. If interest rates were to go up 10 basis points tomorrow unexpectedly, you would lose about 70 basis points in your aggregate bond portfolio. In our fund, you'd lose something like 10 basis points. It's very low exposure. So we have this low exposure to interest rates. We have low exposure to credit risk. We're not terribly fearful of a bunch of these people defaulting on their mortgages. Even if they did default, they have so much equity in their homes, they could sell the house right now and pay off the mortgage, and we would be fine. So if you take all those things together, you have a product with where there's low interest rate exposure, low credit risk, and the yield is, we think, excessively high. Typically, when you find a bond with those safety features built in, you're looking at very low yields. We have reasonably high yields on these bonds. A typical bond that we would buy would be something like a 5.25% yield. To us, that makes no sense given the low amount of risk we're taking to achieve that yield. Except when you look at the mechanics of the fixed income market, you look at it and say, okay, well, we're buying bonds from an esoteric corner of the market. A lot of people don't understand these bonds. It's heavily stigmatized because of 2008. You put all those things together, you can see why there's a premium to owning those bonds. So that's been our focus, to go after non-agency mortgage-backed securities, to find bonds where these yields are excessively high given the amount of risk we're taking. It's been very successful over the years. We continue to find opportunities today. That's the baseline of our performance, is going after these pretty boring, sleepy bonds from pre-2008, and getting that recently 5% yield. Last year was around 3 or 4%. But getting this yield that we think is out of line, given where interest rates are and given the amount of risk we're not taking to achieve that. The last thing I'll mention about this is that we have added considerable value over the years by engaging in what we call special situation trades. These trades come about because banks deliberately made sure that these mortgage-backed securities were as complicated as possible. So let me just go back to the slide deck I had. Here. So this is the picture of a mortgage-backed security I showed you. This is what they look like in real life, and this just kind of gives you a taste of the complexity. Before I had one set of mortgages. We looked at a mortgage-backed security that was a lot like this. There were 4 different pools of mortgages. So we had different color houses here to illustrate that. Each pool had thousands of mortgages in it. The money was pooled together. Well, I should back up. The money was collected each month, principal and interest payments. It was paid out to 4 different classes of bonds. Each of those classes had different tranches in them. Some of the tranches were insured. The shaded ones actually went out and bought an insurance policy to insure that tranche. Notice the tranche above it was not insured. The tranches below it were not insured. Not all these classes had insurance. After these tranches were paid, they would then go to these subordinate tranches. All of the money was pooled together for the subordinate tranches. So some of these tranches had exposure to all the pools, some only had exposure to some of them. And there was some complicated language about exactly how money got allocated. So we love this stuff. We know that the more complicated they make these things, the more misunderstanding there will be in the market as to how these work. Our entire specialty is looking at these very complicated documents, understanding how they work, figuring out when the market gets it wrong, and a lot of times figuring out where the modeling software gets it wrong. Most of the market uses the exact same piece of software to model these things. We have a subscription, it's very expensive, but we will look at the software, and when the modeling software gets it wrong, most of the market gets it wrong, and there's tremendous opportunity for us. We are willing to go to all sorts of measures to make these special situation trades work. We've been involved in litigation. We've found cases where the bond payments were being made incorrectly. We were able to buy the bonds, tell the servicer, you're doing it wrong. You're not paying us enough money. Here's the part of the prospectus that shows that you're not paying us the right amount of money. And in many cases, we had to go to court to argue this. We've made a lot of money off of litigation trades. I don't know any other mutual fund manager who is willing to litigate over mortgage-backed securities. So what that means is that it's not a very competitive space, and the returns we generate from doing that are very idiosyncratic. It's not correlated with the S&P 500. How we do in court has nothing to do with IBM earnings that day. How we do in court has nothing to do with what the 10-year treasury did that day. So it's what everyone's looking for, uncorrelated returns. We can produce returns that are just by their very nature not going to be correlated with anything else in your portfolio. So I'll leave it there. I think I threw out a lot of information. I'm not sure if we're taking questions, but I'm happy to answer any questions that people have.
Yeah, I think we have Q&A turned off. So for everybody that has questions, please feel free to let us know what those questions are, and I'll be happy to share that information with them. Thank you so much, Dr. Jelinek. That was awesome. I'll touch on that a little bit. We really appreciate you being in the portfolio also. We are very excited about having you in the portfolio. We think that there's a lot of potential there, and so we appreciate you coming on and telling everybody about it a little bit.
Okay, my pleasure.
So I'll steal back. How do I steal back the presenter? Yeah, I don't know how to do that. Oh, well, that's fine. I'll talk over. As you can see, one of the big things that we brought to you with that fund is just a very different style of investing in the market. There's David himself. And so, like I said, we tried to find ways to add value. Sorry, I got flustered there. I didn't know where we were. It's a difficult market. Obviously, we're looking for spaces to find value, add returns to the portfolio. We felt like this special situations fund with the litigation and the amount of money, and he didn't go into the percentages that they've been able to add to the portfolio, and we don't even have to do that, but there's been some very big years when they've had success in litigation where they've turned some very large returns for clients. And so we're looking forward to having that ability in the portfolio when we know that the rest of the fixed income space is going to be as difficult as it is this year. So we are very excited to have that fund in the portfolio. So I'm going to close with this, if it'll let me. And go to my little conclusion here. And so I will say this, we are very happy with where we are this year so far. We feel like we've made some very good adjustments to the portfolio. We have a good plan of attack going forward. And we are not worried about where this is going. And we are looking to take advantage of it and find the opportunities versus running away scared from it. But I will say, stop asking the impossible question. So this is something I talk to clients a lot about, and I'll relate it a little bit to a conversation I have with my son a lot right now. My son's 14. He likes to lay out in the backyard. He likes to look up at the stars, and he likes to ask me, yeah, Dad, how can it go on forever? You know, and there's lots of questions out there that nobody has the answer to. We can't possibly know. How does it go on forever? Does it ever stop? All those kinds of things. And I typically laugh with them about it because it's one of those impossible questions to answer. And I think a lot of the fear and anxiety surrounding investing is that people and investors try to answer the impossible question, which the impossible question is, what is the market going to do tomorrow? Where are we going to be a month from now? Are we going into a recession? Are we not going into a recession? These questions are, everybody can speculate. All the talking heads on TV and all the people that you read articles about, they can tell you that they sound very confident in that they know what's going to happen. But the fact of the matter is that majority of them don't have the ability to answer that question. It's an impossible question to answer. Can't tell you how many times in my career I have one on my phone of a very good fund manager that about a week prior to the bottom of COVID came out and said, this is like nothing we've ever seen before. You should move all your money out of the market. And a week later, the market bottomed out and rallied the other direction. So some of these guys are very good at what they do, don't get me wrong, but a lot of them are making calls that they really don't have the information or data to be able to answer that question, and they are just speculating. And a lot of investors take that at face value, and they make decisions based on some of that information that is not necessarily in their best interest. So going back to kind of the whole reason we had the webinar, and the main message I think we want you guys to take away from this is that the market has obviously had a difficult year, and we've made some adjustments to try to weather the storm. But like you've seen through previous difficult market environments, the market has an incredible track record. 100% of the time, it has come back. And so what we try to do is, instead of running away from these difficult market environments, we look for the opportunities in them. If you look at the last 22 years, there's only been maybe 8 major pullbacks. And each one of those pullbacks has presented some amazing opportunities to make money. And so sometimes we actually look forward to these market environments where they give you an opportunity to buy things at a discount, like Warren Buffett says. And so you look at companies that you may have wanted to own over the last couple of years, but they were expensive and now they're on sale. And so now's a great time to start adding some of those positions to your portfolio. If you look at what Warren Buffett is doing right now, Warren Buffett saying he's adding to his Apple position is not because he knows where Apple is going to be next week, next month, or even 6 months from now. He's adding to his Apple position because he believes in Apple long-term and he knows it's a good company. And right now he feels like he's getting a good price for that company with respect to the price of their stock. And so he's adding to his position, knowing that he's going to hold on to that position long-term. And so what we encourage clients to do is think logically, take a deep breath, understand that these volatile times happen, understand that it may not be over. We can't tell you, just like the talking heads on TV, we may go down a little bit further before we find a bottom. I feel like 3,800 on the S&P 500 might be it. It's possible. But hey, if new information comes up, if inflation starts to spike a little bit more, or if they start to jack up interest rates a little bit more, we could find ourselves a little bit lower than that. That's fine. If you look at our tactical positions, we put some of it to work. We still have some dry powder to be able to add some more later. If the market goes down a little bit further, that is exactly what we'll do. If you have IRA contributions to make this year, make those IRA contributions and put that money to work when you feel like we might have good pricing. If you're contributing to your 401k, continue to make those contributions. And on top of it, maybe direct those contributions directly into things like stocks that are on the cheaper side and to take advantage of the pullback that we've seen recently. If you have cash sitting in the bank that you haven't known what to do with, now might be a good opportunity to put that money to work and take advantage of the dip that we've seen recently. The last thing you want to do is run away from it. The last thing you want to do is be fearful. The last thing you want to do is exit the market like the client that I gave the illustration of in 2008 and find yourself sitting in a position much worse than if you would have just hung in there and rode it out. We as a portfolio management team will continue to adjust and make sure that we have you in the right places. We will continue to pivot. We will continue to add money to the markets when we see that it is an opportune time to do that. And we will look long-term to get you the kind of returns that you're expecting from your portfolios. And we feel very confident in our ability to do that. But going back to what I said earlier, I would definitely encourage all of you to readdress or revisit your long-term plan. Look at your goals for the future and make sure that everything is in line and everything is set up so that you're going to accomplish those goals and that your portfolios are allocated appropriately based on whatever your goals may be. This is going to be an interesting year. We are happy that you have all decided to join us on this journey and being clients of Prosperitas Financial and the various different advisors that work here. We thank you very much for your continued support. And if you have any questions, like I said, I believe we turned off question and answer on this actual webinar, but feel free to shoot us any questions and we will pass that on to either myself, to David, or to your individual advisor to get back to you with any answers that we have for you. And that's it. We have gone way over. I hope they're not all an hour and a half long, but like I said, we had a lot of information to share with you. I hope it was good, and I hope that you enjoyed it, and have a good evening.